All right, today we're going to crack open a book that Warren Buffett himself calls by far the best book on investing ever written. We're talking about Benjamin Graham's The Intelligent Investor. But listen, forget all that get-rich-quick stuff. This book is about something way more important, a real proven strategy to build wealth without, losing your shirt in the process. So let's just start with a question that pretty much flips everything you might think you know about the stock market completely upside down. What is the number one goal of investing? Now, if your first thought was to get rich, hey, you're not alone. But according to Graham, you're also missing the most important point. The real goal is something totally different. It's this: to avoid losing. That's it. That's the secret. I know it sounds almost too simple, but this single principle is the absolute bedrock of intelligent investing. You can think of it like building a championship sports team, right? You build your strategy on a rock-solid defense first, because that's what gives your offense the freedom to actually go out there and win the game. Okay, so if rule number one is don't lose money, how do you actually do that? Well, Graham gives us a whole framework, a set of rules designed to protect you not just from a crazy market, but from your own worst enemy, really, your own emotional brain. And hey, this isn't some obscure theory from a dusty old book. Warren Buffett, who was Graham's most famous student, literally said these concepts are the bedrock of his entire strategy. This is the foundation that real, lasting fortunes are built on, not by gambling, but by building wealth deliberately, and maybe most importantly, securely. Now, for the first big question you have to ask yourself. Before you put a single dollar into the market, Graham says you have to know the answer to this. Are you an investor or are you a speculator? Because getting this wrong is just about the fastest way to lose your money. And the difference, it all comes down to your mindset. See, the investor acts like they're buying a piece of a real business, because they are. They carefully analyze its value, its safety, its long-term prospects. The speculator, on the other hand, is basically just betting on price movements. They're trying to ride the waves of market news and rumors. One is about ownership, the other is pure gambling. So you really have to ask yourself, are you standing on the solid ground of business analysis, or are you just trying to surf the totally unpredictable waves of market sentiment? For Graham, intelligent investing means your feet are always planted firmly on the ground. And that brings us to what Buffett calls the three most important words in investing: margin of safety. This is not just some tactic. This is your ultimate financial safety net. It's the one rule that protects you when, not if, but when your analysis is a little off or the market just goes completely haywire. It's actually a really simple but incredibly powerful idea. First, you do the hard work to figure out what a business is actually worth. We call that its intrinsic value. Then, you only buy it when the market is offering it to you for significantly less. That discount, that gap, that's your margin of safety. Let me show you how it works. So let's say you do your homework on a good, solid company. You look at its assets, its earnings, all of it, and you figure out its true value is about $100 a share. That's what it's really worth. But then you look at the stock market, and in its typical moody fashion, it's selling that exact same share for only $60. That gap between what it's worth and what you can buy it for, well, that's where the magic happens. That $40 difference is your 40% margin of safety. It's your buffer. It's your protection against bad luck or making a mistake or just general market craziness. It's quite literally your financial airbag, deploying to protect your capital when things go wrong. So you might be asking, where do these huge discounts even come from? Graham answers this with one of the most brilliant and famous stories in all of finance, the tale of your very moody business partner, Mr. Market. Okay, imagine you have this partner, Mr. Market, and he knocks on your door every single day to quote you a price. On some days, he's totally euphoric. He's read all the good news, and he offers to buy your shares from you for way, way more than they're actually worth. But then, on other days, he's a complete nervous wreck. He's panicking about some bad news, and he desperately offers to sell you his shares at ridiculously low, rock-bottom prices. His quotes have nothing to do with the business's real value. They're just pure, raw emotion. Now, here's the most important part of the whole story. You don't have to trade with him. You can just shut the door and ignore his offers completely. You see, Mr. Market is there to serve you, not to guide you. So how do you take advantage of this manic-depressive partner of yours? The strategy? Well, it requires discipline, but it's actually pretty simple. You turn his emotions into your advantage.
When he's panicked and pessimistic, you use that fear as your opportunity to buy great businesses for cheap. And when he's euphoric and greedy, you can use his wild excitement as your chance to sell at a great price.
And this brings us to the final and honestly the most crucial part of Graham's entire philosophy. Successful investing isn't about having the highest IQ. It's not about being the smartest person in the room. It's all about character. It's about mastering your own emotions so you can avoid the most common and destructive mistakes. Graham warns us against our own worst instincts, right? Chasing after those hot tips, letting fear or greed make our decisions for us, and, of course, thinking we're smart enough to predict the future. The intelligent investor's real job is to build a rational system that protects them from their own human nature. So, what's the ultimate takeaway from all this? If you could distill all of Benjamin Graham's timeless wisdom into one simple formula, this would be it. Investing isn't about genius. It's about temperament. It's the simple but incredibly powerful combination of reason, discipline, and patience. And that is the timeless path to building real, lasting wealth.